Sir. Okay. Okay. Yeah. Slide changer. Good afternoon, all. Okay. Thank you, organizer, for having me faith in me for presenting this topic. So I'll jump into the topic. So investing in stock is becoming a partner in a business where you will be sharing the profit as well as loss. So my disclaimer, this is for educational purpose only. Whatever these stocks names or I will be holding are the only for example only. So already as a salted role, before investing into stock, one should create at least 8 months of expense as an emergency fund, remain a debt-free or minimal debt, and should have an insurance, both term and health insurance. And to make a portfolio, you should invest in equity, you have to invest in a fixed income, some part in the real estate and some part in a commodity, and the asset allocation of them should be 100 minus age in years should be in equity and year age should be in a fixed income. Next, why equity? Over the years, equity has outperformed all the asset classes that from the history of the 120 years of history says. And second thing, equity is the most liquid thing. If somebody invests at 10 lakh with a CAGR of 24%, over a 30 years, it will become 100 crore. That is the magic of compounding. So now the key factors, the most important slide of my presentation is this one. What are the key factors one should look for investments? First and foremost, invest in a company where the business you understand. That is the circle of competence. Next is margin of safety. Invest in a lawyer valuations. Next is always all information should be informed decisions to be taken. Third is asset allocation is most important. People say I have invested this company and has 10 bagger return. That does not give a much of return. But how much portfolio return, that is most important. So allocation is important. Diversification. Invest in a multiple companies. Next is maintain a discipline throughout the investment. And risk management is utmost important in all forms of investment. So Warren Buffett says first, don't lose money. That is the first principle. Second principle, never forget the rule number 1. Next is always object for the long-term investment. Throughout the investment, track your investment. Review and rebalance your investment every 6 months. And cut the losers, ride the winners. Next thing is patience is utmost important. Warren Buffett has created his wealth because of the keeping his investment. He started his investment around 12 years of age and has continued over the till now it is 90 plus. Now, so to make an equity portfolio, and single size does not fit all. Whatever I will be discussing in the portfolio is what I follow. And this risk depends upon individual age, risk appetite, and return expectation will decide what type of portfolio one should make. So what I do is I invest in a core portfolio and satellite, 70% of capital in the core, 30% in the strategically invest in some pattern in the core portfolio, including 10 to 15 stocks. Most of them are consistent compounders with a high quality business. And these are preferred based on the quality of the company, which are growing company, which are the business we expect to be sustainable over a longer duration, and will be purchasing a valuation which is less than the intrinsic value of the company or at par the valuation. But the satellite portfolio, these are strategic investments based on the growth trigger. And basically, this will be based on the price volume action or technical or momentum investment. And always a strict exit criteria should be there for all the satellite portfolio. Now, why to invest? Investing into 15 to 20 stocks as a total. So we normally each invested a 3 type of risk. One is company risk. Number 2 is the sectoral risk. Number 3 is the market risk. By diversifying, we can reduce the sectoral risk to a minimal. By investing into 15 to 20 company, you will be almost exiting the sectoral risk. So market risk will always be there. Next is important the asset allocation or capital allocation. There are three things are there here. What we are seeing is the return. We have somebody is invested 20 companies and had been adjusted from high to low return. Allocation, portfolio A, equal allocation to the all stock. Portfolio B, allocation is reducing allocation as you will go down. Portfolio C, allocation is increased towards the end. But how the return is portfolio B, we are maximum allocations are given to the company who are growing much. Has been given, has provided a nearly 50% of return. While H, if you see portfolio C is negative 42%, portfolio A only 5% return. So capital allocation to the growing company is most important. So usually your returns on the investment depends upon the two factors. One is the price of entry and the exit. Number two, market sentiment, PE at the entry and exits. Now, if you will break down all this, what we can do, any growth of the company depends upon the four things. One is the increasing sales growth, which indirectly depends upon the price and volume. Operating leverage, suppose you have a 30-bed pediatric hospital, you are using only 20 bed, rest then are there. If you are increasing to 30 bed, your profit will start increasing. Margin of expansion. And third thing is the debt reduction. So these are the growth triggers. If the earnings is everything for the company and earning has to convert into a cash flow, then it generates wealth over the thing. So now to those things, so two types of evaluations we have done. We have to do the fundamental analysis as well technical analysis. Fundamental analysis in the initially the price part it tells you earning part, and technical analysis basically the market sentiment it tells us. Now the thing, how I do my fundamental analysis, again I am telling you, fundamental analysis may be individual approach. What I follow is this one. Initially I choose the company which are either debt free or minimum debt, or they are having cash reserve more than the double of their debt thing. Next thing, those who are company who are having high return on investment and return on equity person. Third thing, cash is the king. So what they tell is top line is the vanity, bottom line is the sanity, and the cash flow is the reality. So always look for the cash flow. Any company with increasing cash flow or the return on equity is more than the cost capital, that will give in the highest return. Always look for the competitive advantage, means entry barrier, so that competitors cannot enter into that part of the business. Third thing is profitability and growth. In the profitability, I look for the sales growth, profitable growth, and the business who are increasing expenditure to the research and development, they will remain in the game all through. Slide is not changing. Hi. Next. Yeah. Okay. Yeah. Change it, please. Slide show. Okay, I'll finish it. Why is it showing that one? Okay, quickly I'll finish it. Now, the companies which will be recent new development goes on continuously, and the research expense will be there. New product, new market, new geography they are doing, they will remain in the game. And the promoters is important because you are becoming a partner of that things. They should be honest, experienced, and also have a higher shareholding, means they should be having a faith on their business. And all the time when you are purchasing a stock, that time you should look for the valuation, PEG ratio less than 1 we will expect. And 3 pillars of consistent conduct, credible accounting, means that accounting what they are presenting in annual report should be believable, and competitive advantage and capital allocation. Although when I look for the technical, 2 things are there. Price is increasing, volume is increased, that means it is in a uptrend. Each business has 4 life cycles are there. Always invest when in the growth phase to get a maximum. There should be a strict buy art, sell frameworks, because we cannot buy low, we cannot sell high. So in between, after the smart money comes, you enter into the market and you take a risk that even if it making a 20% below the high price, then you can exit that time. So these are one of the model portfolios would consist of at least Nifty 50 stock 30% of your investment in the Nifty next, 20% in the mid cap, 150 companies from there, and you can invest 20% in the small cap with the different sectors you have to choose. So these are the tools to invest: screener for fundamental screening, trading view for technical charts, sector data point from Treasury Finance, research by it, Concall transcript that gives the maximum input, because what it is not the past or the present, what the promise company give that matters for your returns. And trend line for research report, and ride winners for price volume action. Thanking you, wishing you happy investing.
Fantastic, Dr. Chapay. It was one of the best I've heard on the stock investing, and there's so much material he has gathered, and in 8 minutes talking about. I know the beginners there will be confused, but at least the people who have been doing this amount of equity investing, it will be very helpful. And you can definitely talk to Dr. Chapay in our F3 group of WhatsApp. Those who have not joined, you can join there, or personally you can meet him.